would say, it's more of an art than a science. Drawing it out and taking a step back first, I think, is critical, right, for the long term. It's not true recurring revenue. That's, it's a several $1 million difference from a valuation perspective. Probably the biggest issue that could come slash something that can be resolved is making sure that any potential buyer has all of the information and data from a financial perspective specifically up front. 70 to 80% of deals fall apart, and a lot of that is because it ultimately is emotion. Once you sign the deal, you can't go back. There's a lot that goes into that, right? I think, from a long-term strategic perspective, you have to think, one, is this a lifestyle business? Is this a business that you do want to grow 5, 10x down the road? So again, depending on kind of that answer, you kind of decide on what path you want to go down. If you want to kind of continue to just keep cash flow positive, or do you really want to grow? If you really want to grow, that's where you do want to spend that time to invest and actually have a J curve. So the margins actually go down, you spend the money to invest, and then you kind of see that ROI in the long term. If you wanted more of just a lifestyle business, maybe you just want some small tuck-on acquisitions, then you kind of keep cash flow as is, you don't spend the time to invest, and you look outside to look for those smaller acquisitions targets that are synergistic to you and kind of tuck them in. Whether or not you need financing or not, it's kind of a different story. But those are kind of the two avenues you can go down. I think a lot of people, when they do a transaction, they just look at the EBITDA multiple. It's an easy number to look at, but there's a lot that goes into that, right? So I think when you look at the short-term impact, it's valuation, which really isn't just EBITDA multiple. It's actually looking at qualifying the true adjusted EBITDA, and then from there, understanding what multiple you're getting with what growth rate. Because again, depending on if the company is growing or declining, that changes drastically depending on kind of what multiple you're targeting. For a longer term aspect, I think, you really want to look at how it integrates with the company, and not 6 months, 12 months, but really more 3 to 5 years down the road, to see that, again, potentially a J curve where, the margins go down, but then they go up as revenue increases. So, there's a few aspects there, but I would say, short term, get that qualified adjusted EBITDA and then look at the multiple. Longer term, it's really looking at how it integrated into the larger platform, and seeing how revenue growth happens over time with margin. I would say, it's more of an art than a science. When you're looking at the potential targets, first, it's, is there a geographic slash operational fit, right? So some folks want to be specifically within a certain state or specific region, so that's easy to identify. And then from an operational strategic perspective, what assets are you looking for in a target? Are you looking for adjacent? Are you looking for something you do, but just at a better margin profile, et cetera? So fine-tuning that is number one. And then number two is scraping everything from the pitch books, Cap IQs of the world, spending the time to actually cultivate a really solid email with a headline that someone's actually going to read, because generally, right, they just go into spam. And then secondarily, cold calling surprisingly actually can work decently well if you can find the right contact information and reach out to someone and actually get their attention. And again, it's about what it could be for them, right? Not what it is for you. So when you reach out, you talk about what they can benefit from the conversation, not what you can benefit. And that can be pretty beneficial, if you can get the right contact information. There was someone that was looking at a specific industry within a small region, and thought he knew all the players. That being said, he didn't have the right screening mechanisms, right? And when I say screening mechanisms, looking for companies that have done transactions before, have the cash to actually deploy. So when we looked through our pitch book and Cap IQs and Alpha Senses of the world, we were actually able to find a few others within the area that he didn't know about, which really helped tremendously. He's actually going through with one of those acquisitions right now. So yeah, there's, depending on kind of the probing questions you ask, and then from there, leveraging that to the screening can be quite beneficial. It's a huge intangible. If you don't build that rapport from the beginning, it's a big deal, right? No pun intended. This is someone's life's work, generally 15, 20, 25 years, someone's built this. So if you don't build that trust and rapport in the beginning, then as you continue on with the deal, a lot of issues come up no matter what. And if you don't have that trust in the beginning, right, those issues, items can create falter the deal. If you do build that trust and rapport, then you can have those conversations openly, right? And hopefully be able to, seal those cracks and continue on. So it's really important to build that up front. Especially nowadays, people generally won't answer email, call, right, unless it's someone they know. So if you can, it's kind of like an interview. If you get your foot in the door, and draw to someone that as, hey, this is actually interesting, I want to have the conversation, then you're in, right? And then it's up to you to kind of build that rapport and relationship. If you can't get that, then you're kind of at square one. So that's kind of the big launch pad. If you can get in, then it's much easier to build a relationship. I think, a common issue that we've seen is folks that they come on a little bit too strong, instead of just letting them explain kind of their background, what they need. You see folks coming in and trying to sell too hard, right? And I think a lot of times that scares folks off. So I think kind of going a little bit opposite, sitting back and trying to understand what they need, and kind of what their background is, could be quite beneficial. A lot of folks can be scared of debt, for a number of reasons. I think, if you can get over that hump, right, I think debt can be a very strong vehicle for folks to grow. When you see, I would say the majority of companies that have grown over time, have leveraged debt to do that, right? Because it can accelerate growth quite honestly tremendously. On the equity side, if you're too early on, you don't have cash flow, you still want to grow exponentially, but you don't have that, kind of track record from a financial perspective. Equity is a good way to go because, you can still kind of get that cash up front, without, putting a huge personal guarantee on yourself. And then cash, yeah, I think usually cash is not the way to go because again, you can use that for other things, right? Such as actually acquiring certain assets to improve your business organically. I think, because of all the financial vehicles and leverage that you can do, that's generally a better way. But again, some clients just say, hey, I don't want debt on the books. I'm more old school. I want to use my cash. And to be honest, that's usually the only reason we go cash. Depending on kind of what financing structure you end up deciding on, it's a bit of a loaded question, right? So I think, in terms of debt, you can have senior debt, subordinated debt. So if something goes wrong, people are in line, right? It's like a lot of people are in line depending on kind of the priority of their debt. So that's number one. Including into debt, there's, normal payments, there's balloon payments where, there's a bulk payment at the end. Those are things that you have to structure out because again, everything's going fine, and then one year the business dips a little bit, and then you have this big balloon payment, you can't pay it. So I think the biggest part is just whatever structure you do to plan it out, right? Whether it's a 3 year, 5 year, 10 year, seller note, senior debt, subordinate, it doesn't really matter. But when you cash flow it out from a month to month to year perspective, then you can see, right, if the business is doing up or down. You can maybe either, whether you want to pay something off sooner or draw it out or change the interest rate, right, to finance it. There, drawing it out and taking a step back first, I think, is critical, right, for the long term. I think one, not doing a thorough quality of earnings. Um, Financials, right, is kind of the backbone of the full business. So if you don't do a full quality of earnings to really get a sense of truly what that adjusted EBITDA is and kind of what you're valuing off of, well, then, then nothing else really matters. So I think that's number one. And when you do the quality of earnings, it's not just figuring out P&L and adjusted EBITDA, it's understanding truly the end to end, right? So doing a full cash proof, making sure that revenue recognizes and actually ticks and ties with the bank recs, and seeing, right? Hey, wow, I didn't realize that some of these assets were 25 years old and you may have to invest more. Or maybe it's vice versa, right? And maybe there's actually assets on the books that are brand new and you're getting a little bit of a bang for your buck there. So doing that full quality of earnings, hopefully at least kind of a 3-year historical view on a month-to-month basis, I think is something that, some folks just kind of take as when, hey, we got the P&L, we're good to go. And that's something, once you sign the deal, you can't go back. So I think that's a big one. In the past, 6, 7 months ago, went through an acquisition where we did deep dive into the financials and realized that the revenues weren't exactly the recurring part of the revenue wasn't really recurring, right? It was a little bit more project based. And because of that, the valuation changed somewhat drastically. So again, not just understanding margin and asset, but like going through the entire thing and categorizing gross margin by product and recurring revenue versus non-recurring revenue, because sometimes you're putting a multiple on ARR, annual recurring revenue, or MRR, monthly recurring revenue. So realizing what's actually recurring versus, oh yeah, that's actually one time. Maybe it happens every year or every other year, but it's not true recurring revenue. That's, it was a several $1 million difference from a valuation perspective. So taking that deep dive, asking the right questions throughout diligence is important because it can be a really big value driver up or down. The most important thing, I guess, for us, right, when we're on both sides, but specifically the sell side, we want to make sure that all information is out prior to that LOI, right? Because I think some folks just kind of throw in a value, put an LOI in just so that they can get more information and kind of get to that next step. And ultimately they end up finding things to, retrade, right, or lower the value. So I think that's probably the biggest issue that could come slash something that can be resolved is making sure that any potential buyer has all of the information and data from a financial perspective specifically up front, and which is why we do a quality of earnings initially before the LOI, so they can go through, review it all, make sure that they can provide a true educated valuation on the true either adjusted EBITDA or recurring revenue or whatnot. So when they do their diligence and they do their own quality of earnings and financial analysis, it's more of a check the box, right? And it's not uncovering stuff that they should have discovered pre-LOI. So I think that's probably the most important part that can be an issue if you don't provide the right information up front when folks are drafting an LOI, right, and putting a value on the business. Kind of the quote unquote, negotiating 101, you never really want to kind of put down the first price, right? So I think for a buy side, when you're working with whether it's the owner or an investment bank, trying to get some kind of guidance, right? On kind of value before you put something up, just to get a overall sense, right? And sometimes it's broad and they say, hey, we're looking for mid-single, mid-double digit EBITDA. Or sometimes they say something more specific, right? And then from there, you can kind of leverage that verbiage to your own benefit so that you can, kind of craft kind of the right value, right? So that's I would say probably one of the most important parts. And then, being upfront, I think, and a buyer in terms of whether or not you need financing, diligence timing. Some buyers say, hey, we can close in 45, 60 days, or we never retrade, and then they retrade and you kind of lose a lot of trust. So it sounds cliche, but just being open and thoughtful on kind of what you say and how your process works on the buy side, it can be very beneficial, right? Not for just that deal, but just for the overall relationship for other deals if you work with these parties down the road. pretty much every single deal, we'll tell the client that there's going to be deal fatigue at one point or another. And again, when that does happen, we kind of joke, right, and say that we're part-time M&A advisors and part-time psychiatrists, right? Because we help support them throughout. And I think honestly, it's truly, and it sounds simple, but it's truly being there and being kind of that thought partner when those things happen, right? So whether it's small or big, at the time, this client has, potentially built this business for 20, 25 years, and they think something's falling apart. And this is after a month or 2 months of diligence, and they're exhausted. So taking a step back, right, and kind of one, explaining to them where they're at, what's normal, what's not. Hey, this is actually very normal. I understand it's very overwhelming for you right now, right? But this is actually a very normal part of the process. We need another, whatever it is, 5 business, 10 business days, and then we're going to be closing, right? Kind of taking a step back and kind of painting the picture for them is important because it can be very frustrating, right? And you're spending all this time on not only your business, but now this additional thing that you don't know much about. It can be very overwhelming. So yeah, again, continuing to stay in lockstep, right? Whether it's a buyer seller throughout the entire process, and kind of knowing when there's going to be overwhelming parts and kind of trying to get ahead of it is huge. Because again, I think it's like 70 to 80% of deals fall apart. And a lot of that is because it ultimately is emotion, right? Someone gets frustrated or they don't understand something and they just say, I don't care. They're trying to screw me and that's it. And then it falls apart and it didn't need to, right? So I think someone really being a part the whole time, which is important because again, a lot of folks, they sign an LOI and they kind of say, all right, good luck. We'll see you at purchase agreement or sign. And again, because we don't take a huge success fee, right? And we charge hourly and we're there the whole time, it creates a much higher success rate for us and close rate. The number one is getting ahead of it, right? So when the deal closes, it's not okay, well, what are we going to do next, right? I think it's, call it 30 days, 45 days before the deal closes, getting the appropriate folks up to speed that are already kind of in the loop, right? So that once you are on that, hey, we're closing in the next, I don't know, day, 2 days, week, you already have a full plan in place. So that's number one. And right for my kind of corporate development days, and we did a lot of internal integrations. It's getting kind of those right folks, right? Where it's the head of HR, head of operations, head of environmental, health and safety, right? Getting all those folks and knowing, hey, this is what we're at. This is what we need for the first 30, 60, 90 days of post-close integration. And then honestly monitoring it, right? It's literally just project management. So usually I like to do kind of an every week we do a check-in, you do a classic status, right, of every single item, high criticality, low, medium, and you kind of go through and say, hey, where are we at, where are the issues, what can we resolve, right? And just do that every single week. It can be a little bit mundane and tedious at times, but you do that every single week at least for the first month. And then you kind of do every other week and whatnot, and you kind of continue to follow that pattern, and it helps a lot, right? Because a lot of times, the deal folks usually leave, right? The deal closes, everyone high five, they have their dinner and they leave, and then it's kind of left to the business folks, and a lot of times it falls apart, right? Because they're not part of the entire transaction, right? So they don't know all the ins and outs. So I think having someone that's been part of the deal to continue to help lead integration for the go forward or bringing someone in at the right time is critical for it to be a smooth process or a smooth handover process. Number one, which I didn't take as seriously, was building the relationship not with your client, but with the person that's selling the business, right? Because again, that person is the one that built this baby for 30 years, is selling, and they're just giving it away to someone that they don't know well, right? And generally speaking, especially smaller deals, they don't know the process, right? Whether they have an advisor or not, they don't understand the process. They generally don't just, unwittingly trust the other side. And if something small happens, then that's kind of it, right? And then the deal kind of falls apart. So if you can build that relationship with the other side from the beginning, and be in lockstep, so when things happen, you can explain to them, right? Hey, just want to let you know before we send this over or before we start talking about network capital, I want to explain how it works, right? So it's not a surprise when we send this over. It builds a lot of goodwill if you can do it from the beginning, right? Whether it's with the client or with the investment bank, it doesn't really matter, but building some part of that relationship on the other side. So that way, you can kind of continue that go forward, because it's a bit of a marriage for a few months, right? You're talking back and forth literally every day, all day for at least 60 to 90 days. So I think building that relationship from the beginning can be very helpful to actually get the deal done, especially when there's issues that come up. Hire an advisor. And what's funny? I think, if I ran a company and I didn't know much about M&A, I don't think I would hire an advisor, right? Because I was like, I know enough. I can kind of get it done, which I completely understand. It's one of those, you don't know what you don't know, and until you go through a process and by yourself, right? And oh my God, like, you don't realize how much work it is, two, how much you don't know, and then three, at the end you can say, okay, well, I got the deal done, but was it really worth it, right? So maybe the value was okay, but the structure is awful, and you end up having, you don't realize it, but there's a seller's note for 10 years, and you're not even gonna get your money for at least 7 or 8, right? So like, there's so many things that are part of the deal people don't realize. And again, it happens a lot where a client either tries to go through it themselves, or a client tries to go through it themselves and then use an investment bank, right? Like a small broker that doesn't really even know your name, doesn't know the business well, just throws it out there, doesn't get a good value off it. And then they ultimately come to us. And I think we've done it now 4 or 5 times where a client has tried to sell twice, hasn't worked, and then come to us, and then we ultimately get the deal done, right? And again, I don't think we're doing anything unique or special. It's really more just a matter of taking the time, crafting the story in the right way, right? And finding the appropriate buyer, and honestly holding their hand through diligence. Because again, things come up. So yeah, I think that, and honestly getting a good M&A attorney. Those are two big ones that, if it can make the process much smoother and a lot less of a headache.